In 1971, Nixon killed the gold standard. In 2008, banks crashed the world. And today, money itself is morphing into energy, from Bitcoin's 350 terawatt hours consumption to solar farms traded like stocks. Is this the real death of traditional investing? This story will stun you. Why do the old rules feel broken all of a sudden? They built empires on margin of safety and low price-to-book ratios, yet today those once unbreakable rules feel outdated and fragile. Why has value investing, long the bedrock of Warren Buffett and Benjamin Graham, begun to crumble right before our eyes? From Ben Graham's Security Analysis, 1934, written amid the Depression, to The Intelligent Investor, 1949, value investing thrived on principles: buy undervalued businesses and wait for the world to catch up. For nearly a century, the value premium, value stocks outperforming growth by around 4.4% annually in the US, seemed nearly invincible. But cracks began showing in the late 1980s. Companies started pouring billions into R&D, software, brands, intangibles that book values failed to capture. As a result, traditional metrics systematically labeled fast-growing cow glamour firms as overvalued, while truly innovative businesses appeared cheap. The median market-to-book ratio tripled between the mid-80s and 2018, and the distinction between value and growth blurred. Do you see how accounting itself may have skewed what we once trusted? Then came 2007 and the global financial crisis. Suddenly, that age-old value strategy falters again. Research from NYU Stern shows value investing has largely failed over the past 30 years, aside from a brief boom after the dot-com bust. What if the world has moved on, but our models remain locked in the past? Even over the last decade, the divergence is staggering. U.S. growth stocks have outperformed value by 7.8% per year on average. In absolute terms, value managers simply can't compete, even when their strategies are unchanged. Why haven't investors reacted? Scandals hide in the data. Active fund managers, many pursuing value over the past 14 years, failed to beat the S&P 500, thanks in part to growth's dominance. In 2023, 60% of U.S. large-cap active funds underperformed the market. That means seasoned pros, armed with valuation tools, still lag the index. Are we all missing something? You, as a thoughtful insider, may sense that something fundamental has shifted. The tools we trusted are becoming obsolete, and only a few will grasp what replaces them. Soon, we'll dive into what really holds worth now that book value misses so much. What if real value isn't dollars, gold, or stocks, but watts, joules, the energy powering civilization? They measure value in kilowatt hours now, not cash. What if the stuff that lights your home, that powers our lives, is the currency itself? Imagine this: the average person uses around 3,300 kilowatt hours of energy each year. That's not a loose number. It comes from detailed data on global energy use per person, highlighting both our reliance on power and how unequally it's shared. Picture two families, one in a high-tech city, plugging in every convenience, another in a remote region with fluctuating supply. That gap is value. Enter energy-backed tokens, digital units representing real energy, like a slice of solar watt-hours or wind-generated kilowatts. Each token is tied to actual energy flow, not fiat printed endlessly. Scarcity becomes literal. Finite kilowatt hours. This isn't theory, it's unfolding. Tokens link directly to real-world power, escaping inflation from endlessly printing money. A token might equal 1 kilowatt hour from solar. Your ownership means accessing actual energy, not just a ledger entry. But what if energy prices spike like oil crises of the past? There's a twist. Renewables offer steadier returns. Solar and wind generate predictably once built, insulated from fossil fuel volatility. That opens a question. Could these tokens be your safest bet? Now consider the psychology. This is exclusive knowledge. As someone curious enough to follow, you're among few who see power as currency, and there's a subtle risk. Don't let your portfolio lose power by sticking only to old money systems. We can already glimpse the revolution. Anyone, regardless of funds, could own a slice of a solar field or wind farm, a democratized future once hidden behind banks and brokers. The gates to energy markets crack open. Imagine where this goes. This tokenization isn't about tech. It's about transforming your access to value itself. How do you invest when energy is the currency? Let's uncover why this demands a fundamental shift in how we build portfolios. How can a solar farm outpace Buffett's safest bets today? Buffett built empires on timeless value, yet now a mammoth solar park shines brighter in returns. What's shifting under our feet? Buffett's hold forever mentality, anchored in deep fundamentals, once reigned supreme. But today, active managers are enjoying uncommon success. In early 2025, only 54% of large-cap active funds underperformed the S&P 500, down from 65% in 2024, marking their best relative performance since 2022. This resurgence hints at a market that's no longer purely predictable. Yet, despite this momentary turnaround, long-term data paints a sobering picture. Over the past decade, only 8% of active large-cap US funds beat their passive benchmarks, and mid-cap just 18%, small-cap 25%. Ask yourself, are we clinging to old titles when the real growth is elsewhere? Because infrastructure, especially in energy transition, is surging. Since 2004, infrastructure investments have averaged 10% net IRR, with double-digit annual returns in sectors like data centers and renewables. In 2025 alone, private infrastructure fundraising surged to $115 billion, outpacing all of 2024. These aren't theoretical plays, they're capital pouring in from every financial corner. Imagine the world powered by Cleve Hill Solar Park in the UK, a 373 megawatt behemoth covering nearly 900 acres, complete with battery storage to light homes after sunset. That's not speculation. That's value built on real energy generation. And it's not just large-scale deployment. Fund strategies are changing too. In 2023, 43% of all newly launched infrastructure funds focused exclusively on renewables or digital assets. Although it dipped to 32% in 2024, it still mirrors a persistent 5-year average. Meanwhile, government green banks are scaling up. Australia's CEFC is now managing over $32 billion, with $4.7 billion committed just in the last year. Now here's where it flips. Diversified portfolios used to mean hold a bit of this and that. But in this era, without exposure to clean energy, DEFI, or decentralized infrastructure, diversification may leave you unprotected. So ask yourself, are you just another passive observer or a forward thinker steering energy futures? You've got to move from being an investor to becoming a steward of the energy transformation. These energy assets aren't just sustainable, they may be the fortress investments of the future. What does this mean for the models we rely on? Let's probe further. Why are traditional financial models failing to see this shift next? Why CAPM and perfect markets fail now? Models gave us confidence, yet when crises hit, equations that promise precision fall silent. What if the math itself is outdated? The capital asset pricing model, CAPM, anchors much of modern finance. It says expected return equals risk-free rate plus beta times excess market return based on assumptions of perfect, complete markets and rational agents. But here's the catch. This charming simplicity rests on shaky ground. It assumes no transaction costs, uniform expectations, and that all risk fits neatly into variance. Scholars from MDPI challenge this foundation. They argue that neoclassical finance, rooted in perfect capital markets, fails to capture the real world's imperfections. In practice, we see incomplete information, irrational behavior, regulation, and crises, none of which these models account for. It's like using a map of calm seas to navigate storms. Resistance to change, though, runs deeper than just stubborn academics. Our entire financial education system, audit standards, even court rulings lean on these models. Abandoning them threatens institutional stability. As MDPI puts it, replacing the neoclassical paradigm is slow, complex, and many are simply not trained for it. But what if models could evolve? Here's the twist. Simulation-based valuations, like Monte Carlo techniques, layer in uncertainty and reflect market messiness. The new methods allow us to model imperfect markets, volatility, behavioral risk, options excluded from CAPM's neat lines. It's paradoxical. We model imperfection to better predict. Further, alternatives like downside beta models or multi-factor models embrace skewness and real-world shocks, particularly valuable in unpredictable markets. Or take hierarchical risk, parity, HRP, a machine learning portfolio framework sorting assets into clusters and allocating intelligently, designed to outperform classical mean variance optimization. If you're questioning the equations, you're among few who can adapt. The paradox is powerful, using imperfect tools to navigate perfection-seeking systems. And maybe the most surprising fact, even CAPM, a 6-decade-old stalwart, may now be relic from a world that no longer exists. So if both macro assumptions and micro models are outdated, where does that leave investors? Let's reimagine strategy from the ground up. New strategies for an energy-driven economy. The future isn't about tweaking old tools, it's about building new ones forged in energy's fire. Why cling to yesterday's models when the economy around us is being reborn? Take carbon currency frameworks, for example. Imagine a currency whose value reflects how much carbon gets sucked out of the sky, like 1,000 kilograms of CO2 mitigated for 100 years, and backed by central banks globally. This isn't pie in the sky, it's called carbon quantitative easing, CQE, a radical monetary policy that guarantees a rising floor price for this carbon currency, reinforcing long-term investment in decarbonization. You're watching the toolset of climate finance transform in real time. These instruments nudge markets toward cleaner energy with predictable growth, not volatile subsidies or fleeting tax breaks. Carbon rewards inject debt-free incentives, flowing as financial value directly tied to verified climate action. Picture incentives that don't vanish, they rise with each ton of CO2 removed. Now, switch gears to Smart Bond, a non-government monetary experiment that fixes supply growth at 6%, distributes all new supply as interest to holders, and enforces an exchange rate floor through blockchain-based protocols. No central bank operator to tweak rates on a whim. Scarcity is baked into the code. Only holders benefit. If you aren't in the know, you'll miss out. But what about policy risks? Government shift, market swing. Here's how supranational frameworks plan to steady the boat. With internationally coordinated CQE, central banks act in concert to uphold the currency's floor price and shield markets from spooked volatility. The rules they set are hard to reverse. That's stability few mainstream investors see. And then there's decentralized energy finance, think DeFi and DePIN, fueling clean infrastructure in peer-to-peer markets. Investments channel directly into microgrids, renewables, and local energy production, democratizing ownership and capital flow. Fractional ownership of a solar panel? Now possible. Here's a jaw dropper. Centuries before central banks printed their first notes, governments didn't treat carbon mitigation as currency. Yet today, markets may accept carbon mitigated units as money decades ahead of any fiat innovation. That's a paradigm shift. So, where does this leave the individual investor? With a new map. Let's close the loop by exploring what this all means for your own portfolio and how time, energy, and money now merge like never before. How to invest when time, energy, and money converge. Your life's most important goals, retirement, education, legacy, aren't just measured in years or dollars anymore. Imagine if those milestones now hinge on real energy, not fiat. We've reached a moment where time equals energy equals money. Forget dusty spreadsheets. Instead, think in renewable tokens, project-backed ETFs, carbon-linked instruments. The rulebook is flipped. Here's your first actionable idea. Renewable energy tokens, real slices of actual kilowatt hours produced by solar or wind. These aren't speculative, they reflect physical flows, not bonds or margins. Backed by transparent tech, they deliver actual value tied to energy generation. Next up, infrastructure ETFs provide broad access to the energy transition. For example, since 1973, infrastructure assets delivered an average 9.9% real return when inflation was high, but cooling, 2.3 percentage points above long-term averages. Notably, BlackRock reports infrastructure ETFs have surged in popularity across the US and Australia, US inflows rose 35% in 3 years to mid-2025, while Australia's Glyn Fund pulled in over $660 million in 2024 and another $330 million so far this year. That's proof. These assets aren't just green, they're resilient. Carbon-linked instruments, whether futures, offsets, or tokenized carbon credits, offer inflation-protected value tied to climate action. Pair them with infrastructure exposure, and you hedge inflation while rewarding sustainability. Now ask, in a high-inflation world, what asset holds value? The energy sector outperforms 74% of the time, delivering 12.9% real returns annually according to Hartford Funds. That's not minor, it's a tidal shift. But what's the ideal mix? Here's the twist. Energy-anchored assets both hedge and reward. You get inflation protection from infrastructure, growth from renewables, and scarcity value from energy tokens. A layered portfolio built on energy is not just defensive, it pushes forward. You might worry, will I fall behind? Don't let your portfolio lose power. As an insider, you're among those getting ahead of this shift. This isn't typical investing, it's pioneering. The best bank for future wealth may not be a vault at all. It could be a solar field, a wind corridor, or a carbon token, generating real value while standing firm where fiat wobbles. You've just uncovered secrets that most investors will never see. Value investing may be history, but you're now ahead of the curve. Join this circle of insiders, watch the next video, and subscribe before the old playbook disappears forever.